Imagine waking up tomorrow to find that every transaction you make, every investment you hold, every loan your business needs is controlled by institutions you've never elected, never chosen, and barely understand. The truth is, you don't need to imagine it. This is already happening. Right now, a handful of powerful institutions hold more influence over the global economy than most governments. They decide which companies thrive, which nations receive financial aid, and how your retirement savings are invested. The question isn't whether power is concentrated. It's who holds it and what they're doing with it. Welcome to Financial Stories of Wealth, where money, history, and power come together. Today, we're pulling back the curtain on the global financial system. Who actually controls it? Is it governments, central banks, or something far more complex and interconnected? As we dig deeper, you'll discover that the answer involves institutions founded nearly a century ago, modern investment giants managing trillions, and an intricate web of influence that touches every aspect of your financial life. By the end of this, you might see the world economy very differently. Let's start with the foundations, the institutions born from crisis. In 1944, as World War II raged, representatives from 44 countries gathered in Bretton Woods, New Hampshire, with a single mission: prevent another Great Depression. From this conference emerged two titans that would shape global finance for generations: the International Monetary Fund and the World Bank. The IMF was designed to ensure monetary stability, providing emergency loans to countries facing balance of payments crises. The World Bank focused on long-term development, rebuilding war-torn nations, and later funding infrastructure projects worldwide. But here's what most people don't realize. These institutions operate on a quota system, where voting power is directly tied to financial contributions. The United States, as the largest contributor, wields extraordinary influence. Research shows that the U.S. is the IMF's most powerful member, with its influence extending even into individual loan agreements. This isn't just theoretical power. It's practical control over which countries receive assistance and under what conditions. When Greece faced financial collapse in 2010, it was the IMF that set the terms for bailout, requiring harsh austerity measures that affected millions of citizens. The pattern repeats across continents. Countries in crisis must often adopt policies favored by major economies to receive support. Critics argue that these institutions have evolved beyond their original mandate. A recent study analyzing World Bank and IMF policies found a dual impact. While they facilitated economic stabilization and infrastructure development, their conditionalities often exacerbate socioeconomic inequalities and limit policy autonomy in recipient countries. The institutions prioritize what some call neoliberal agendas over equitable development. Nations classified as emerging markets account for approximately 60% of global GDP, but hold only 40% of voting power within the IMF. This structural imbalance means that developing nations have limited say in policies that directly affect their economies. Now, let's move to an institution most people have never heard of: the Bank for International Settlements. Founded in 1930, the BIS is literally the central bank for central banks. Based in Basel, Switzerland, it hosts 63 member central banks and serves as the nerve center for global financial coordination. The BIS doesn't operate like a typical bank. You can't open an account there unless you're a central bank or monetary authority. What makes the BIS extraordinarily influential is its role in setting global banking standards through the Basel Committee on Banking Supervision. The Basel Accords, Basel I, II, and III, establish capital requirements that banks worldwide must maintain. These aren't just suggestions. They're international standards that determine how much money banks must hold in reserve, how they assess risk, and how they operate daily. When the 2008 financial crisis exposed vulnerabilities in the banking system, it was the Basel Committee that crafted Basel III, requiring banks to hold more capital and maintain better liquidity. This decision affected every major bank on the planet, influencing lending practices, mortgage rates, and business loans from New York to Tokyo to London. But the BIS operates in remarkable secrecy. Its bi-monthly meetings bring together central bank governors to discuss global economic conditions. Yet these discussions happen behind closed doors. There's no public voting, no press conferences detailing every decision. The institution argues its privacy allows for frank discussion without market panic. Critics counter that such power exercise without transparency is fundamentally undemocratic. The BIS essentially sets rules that govern trillions in global banking assets, yet operates with minimal public accountability. Let's talk about the Federal Reserve, perhaps the most powerful economic institution in the world. Created in 1913 after the devastating panic of 1907, the Fed manages U.S. monetary policy, regulates bank holding companies, and monitors systemic risk. Its decisions ripple across the globe because the U.S. dollar serves as the world's primary reserve currency. When the Fed raises or lowers interest rates, emerging markets feel the impact immediately through capital flows and currency. The Federal Reserve's influence extends far beyond American borders. During the 2008 financial crisis, the Fed provided emergency dollar liquidity to foreign central banks through swap lines, essentially becoming the lender of last resort for the global financial system. In 2020, during the COVID-19 pandemic, the Fed's actions, slashing interest rates to near zero and purchasing trillions in assets, stabilized not just American markets but global finance. The Fed's balance sheet expanded from under $1 trillion before 2008 to over $8 trillion at its peak. Here's where it gets controversial. The Fed operates as what it calls an independent institution within government. The president appoints governors, but once confirmed, they serve 14-year terms specifically designed to insulate them from political pressure. Yet former Fed Chair Paul Volcker argued that the lack of global consensus threatens financial reform efforts. The Fed must balance domestic mandates, maximum employment, and stable prices, with its de facto role as the manager of the world's reserve currency. This dual responsibility creates tensions, especially when global needs conflict with American interests. Now we arrive at the modern giants, BlackRock, Vanguard, and State Street. Together, these three asset managers control approximately 10% of all global assets, over $20 trillion. To put this in perspective, that's more than the combined GDP of China, Japan, and Germany. They're the largest shareholders in roughly 88% of S&P 500 companies, including tech giants like Apple, Microsoft, and Amazon, as well as major banks, pharmaceutical companies, and energy corporations. BlackRock, founded in 1988, manages over $11 trillion through its vast network of investment products, particularly exchange-traded funds under the iShares brand. But BlackRock's real power comes from Aladdin, a sophisticated risk management platform that processes data on more than $20 trillion in global assets. Major financial institutions, insurance companies, pension funds, and even central banks use Aladdin to make investment decisions. This gives BlackRock unprecedented insight into market flows and institutional positioning. Some financial analysts describe Aladdin as the brain behind global markets, with BlackRock CEO Larry Fink called the King of Wall Street. Vanguard operates differently. Founded in 1975 by John Bogle, it pioneered index investing and maintains a unique structure where the company is technically owned by its fund shareholders. This structure gives it a democratic image, offering low-cost index funds that made investing accessible to millions. However, passive investing at this scale creates its own concerns. When Vanguard automatically owns stakes in thousands of companies through index funds, its voting decisions on corporate governance affect entire industries. Recent reports show Vanguard holds over $86 billion in coal investments alone, making it the world's #1 investor in the industry despite public commitments to sustainability. The concentration of power in these three firms raises fundamental questions about market competition and corporate governance. When the same institutional investors own significant stakes in competing companies, say both Coca-Cola and Pepsi-CI, or multiple airlines, do those companies really compete as aggressively? Research from the American Economic Liberties Project argues we're witnessing a modern money trust reminiscent of the J.P. Morgan and Rockefeller era. The difference is that ownership is technically dispersed across millions of individual investors, but control is concentrated in the hands of a few asset management giants. These firms also wield enormous political influence. BlackRock was hired by the Federal Reserve during the COVID-19 crisis to manage emergency asset purchase programs. Critics pointed out the obvious conflict of interest, BlackRock advised the Fed on which assets to buy, while managing similar products that could benefit from those purchases. The firm has also advised the European Union on integrating environmental and social governance factors into financial regulations, despite holding substantial positions in fossil fuel companies. Representatives from Vanguard sit on government advisory committees addressing climate-related financial risks, while the firm faces criticism for its fossil fuel investments. The Financial Stability Board represents another layer of global financial governance. Established after the 2008 crisis, the FSB monitors and makes recommendations about the global financial system. It coordinates national financial authorities and international standard-setting bodies. However, the FSB's decisions carry no legal binding force. It operates through what experts call moral suasion and peer pressure. Member countries commit to implementing FSB policies, but there's no enforcement mechanism. This creates a system where powerful economies can influence global financial standards through the FSB, but smaller nations have limited ability to ensure compliance from larger players. The architecture of global finance involves layers of institutions with overlapping mandates, but limited enforcement power. National governments retain sovereignty over their financial systems, yet international institutions constrain their policy choices. When a country joins the IMF and World Bank, prerequisites for accessing global capital markets, it accepts a framework of rules and expectations. When banks operate internationally, they must comply with Basel standards even though the Basel Committee has no legal authority. The system works not through formal law, but through economic necessity and peer pressure. This creates what scholars call the international financial architecture, a patchwork of institutions, agreements, and practices that evolved over decades without central coordination. No global financial regulator exists with enforcement power comparable to domestic regulators. Instead, we have committees, boards, forums, and organizations where officials from powerful economies negotiate standards that become de facto global rules. The G20, composed of the world's largest economies, meets regularly to coordinate macroeconomic policy. The Financial Stability Board brings together finance ministers and central bankers. The World Economic Forum provides a platform where business leaders and policymakers shape discourse around economic issues. Critics point out that the system inherently favors established powers. When reforms are needed, they must pass through institutions where voting is weighted toward wealthy nations. When crises occur, assistance comes with conditions that reflect the policy preferences of creditor countries. When new financial technologies emerge, like cryptocurrencies or digital payment systems, the regulatory response reflects the interests of countries hosting major financial centers. The result is what some economists describe as financial governance that maintains existing power structures rather than adapting to a multipolar economic reality. The COVID-19 pandemic exposed both the system's resilience and its vulnerabilities. Central banks worldwide coordinated unprecedented monetary stimulus, demonstrating capacity for global cooperation. The Fed's dollar swap lines with other central banks prevented a liquidity crisis from becoming a complete financial meltdown. Yet the pandemic also revealed deep inequalities in the system. Wealthy nations could borrow at historically low rates to fund massive stimulus programs. Developing nations faced surging debt burdens and limited access to capital. The IMF provided emergency financing, but many countries emerged from the pandemic with debt levels that will constrain their development for years. Looking at the broader picture, we see a global financial system where formal institutions like the IMF, World Bank, and BIS establish frameworks and standards, while informal power dynamics, U.S. dollar dominance, concentrated asset management, political influence, determine how those frameworks function in practice. The system isn't controlled by a single entity or secret cabal. Instead, control is distributed across multiple nodes: central banks wielding monetary policy, international institutions setting standards, asset managers voting trillions in corporate shares, and governments negotiating bilateral and multilateral agreements. As economist Paul Volcker noted, the lack of global consensus on key issues threatens reform efforts. When different countries have conflicting interests, emerging markets seeking more representation, developed nations protecting established advantages, creditors prioritizing repayment, debtors seeking relief, achieving meaningful reform becomes extraordinarily difficult. The system muddles through crises, adapting incrementally rather than through comprehensive overhaul. This creates a financial architecture that's remarkably resilient in some ways, yet vulnerable to systemic shocks in others. The concentration of assets under BlackRock, Vanguard, and State Street represents a qualitatively new development. Never before have so few institutions controlled such a large percentage of global corporate ownership. This concentration creates potential risks. If one of these giants faces a crisis, the systemic impact could dwarf the 2008 Lehman Brothers collapse. The institutions are interconnected through their holdings, their use of common platforms like Aladdin, and their relationships with the same central banks and governments. A failure or major disruption at any node could cascade through the system. Yet the system persists because it serves certain functions effectively. The IMF does provide emergency liquidity when countries face currency crises. The World Bank has funded infrastructure that improved millions of lives. The Basel standards did make banks more resilient after 2008. The Federal Reserve's actions prevented the 2008 crisis from becoming another Great Depression. Asset managers do provide retirement security for hundreds of millions of people worldwide. The question isn't whether these institutions serve any positive function. They clearly do. The question is whether the concentration of power they represent serves the broader public interest or primarily benefits those who control them. This brings us full circle to where we started. Institutions you never elected, making decisions that shape your financial future. The global financial system operates through a complex web of formal institutions and informal power relationships. Central banks coordinate through the BIS while competing for economic advantage. International financial institutions provide stability while enforcing policy preferences of their most powerful members. Asset management giants invest your retirement savings while wielding unprecedented corporate voting power. Governments regulate domestic finance while ceding authority to international standards they can't unilaterally set. Understanding this system matters because it affects every aspect of modern economic life. The interest rate on your mortgage, the returns on your retirement account, the stability of your national currency, the policies your government can pursue, all are influenced by institutions operating in this global financial architecture. Whether you see this as necessary coordination in an interconnected world or dangerous concentration of power depends on your perspective. What's undeniable is that the system exists, wields enormous influence, and operates largely outside traditional democratic accountability. So here's where I want to hear from you. After learning about the institutions that shape global finance, from the IMF and World Bank to the Federal Reserve, from the BIS to BlackRock and Vanguard, what do you think? Does this concentration of financial power concern you? Or do you see it as necessary for global stability? Should there be more transparency and democratic oversight of these institutions? Or would that undermine their effectiveness? Do you believe the current system serves the broader public interest? Or does it primarily benefit a financial elite? Drop your thoughts in the comments below. I'm genuinely curious about your perspective on who should control the global financial system and how it should be reformed, if at all. If you found this deep dive valuable, hit that like button and subscribe to Financial Stories of Wealth. We're committed to bringing you the facts about money, power, and the systems that shape our economic world. Next time, we'll explore another crucial financial topic that affects your life in ways you might not realize. Thanks for watching, and I'll see you in the next one.